Afternoon, hopefully not too late for any of you. Welcome to our new financial modeling webinar. So I welcome to the people on YouTube. Some of you guys are maybe watching this live stream on the startup channel, on their startup club channel. Some of you guys hopefully signed in for the Zoom session. So welcome all. Today I want to talk a little bit about how the pitch deck goes from pitch deck to funding, which people tend to think is a super straightforward process. I was literally talking to this founder this morning that was just cold emailing a pitch deck, which we're going to talk about in this. Cold emailing his pitch deck, and his expectation was that the round was just going to close on that. And then I think that the reality of things is that it takes a lot longer and it's a lot harder. So this is the way people imagine it. This is the way it looks. And today I want to debunk a little bit of that. I'm going to spend most of my time talking about the pitch deck itself, but we'll touch into a few other points. And the only reason why we understand this is because we've been doing this for a while. We've been helping founders with their fundraising for about 10 years now. And these are some of the red flags that we see through this process, right? So from the pitch deck to the reach out process to finding the wrong type of investor. So those are the red flags that we're going to talk about today. So just a little trivia question. I've gotten better at multitasking. So I have your, sorry. I have your chat and our Q&A here. So if you want to drop it in the chat, I have a little trivia for you. So let's see if you guys can figure out what's wrong with this slide. I'll give you like 10 seconds to try and type it in. What do you think is wrong with that slide? Any takers? Vague. Okay, Mark says vague. Oh, fair. It is a little vague, but that's not all that's wrong with it. So problems with this slide. So we'll start with TAM. So like the TAM slide, this is a TAM slide, total addressable market size slide. Same idea. The main objective of a TAM slide is to find or to answer the question of how big is your company going to get. That's the answer that should be here. And a lot of customers, a lot of founders kind of try and go with this TAM SAM sum approach, which I normally think is unnecessary. Normally, what you want to just go with is like, how big is my company going to get? And the size of your company is really determined by, it's not determined by, hey, we're going to be 1% of this huge market. That's not the way it works. It's, hey, we're going to have these many customers, and these customers are going to be paying us this much. That's how you gauge the size of a business. So sounds simple, but in a nutshell, it sounds simple. It's not, but in a nutshell, you should be focusing on, customers times revenue. Now, this is a top-down approach where we've suddenly identified that we have a $620 billion market of early adopters in the EU, which just right off the bat, that number seems too crazy to be true. And then again, we're just kind of doing this top-down approach where we're going to say, hey, we're just going to take 7% of early adopters in the EU. But is that real? Like, is every early adopter going to need whatever this product is? This is a real slide from a real pitch deck. We've edited out some of the colors so you won't figure out what company it was. But point being, this is a bad slide because it's a top-down approach. It's somewhat vague, yes, in the target audience, but it's not answering the question of how big this business is going to get. Just saying, hey, we're going to do 7% penetration in every country. That's not an answer to this complicated question. We're going to touch more on the TAM slide in a sec, but I have another trivia for you guys. Just one more. So what's wrong with this other slide? I'll give you guys another second, and I'll move out of the way. Let's see if any takers here. So this is a go-to-market slide. Granted, this comes from a real deck that we received. Just a list of activities. There you go. So Nathan put a nail on the head. They don't know the target customers. E-commerce ads in active marketing. Yeah. So the problem is this is just a list of marketing tactics. It's not a strategy. It's not a go-to-market strategy. It's not telling investors that you're better at go-to-market than any of your competitors. It's not telling them that you have an advantage. You're literally just listing marketing tactics, and that's it. And that doesn't work because an ideal go-to-market slide should be a good breakdown of what you do that makes you different, that makes you special, that gives you an edge against all of your competitors, and that's what this slide should be. So you guys are right on the money with that. Okay, good. So just a reference, I have, I normally like to take like two different paths with the next few slides, and that really depends on what you guys feel is more urgent to you. So let me ask you and go from there. Where are you struggling the most with your deck? Um, Three options or three usual answers that we get. First is story, right? So if you're struggling, maybe summarizing the company's story or compressing the slides into, to your 15, 20 slides, or figuring out what to include and what not to include, just type out story, and that way I'll know you're part of that club. The other chance is that you're struggling with a specific slide. There's a slide that you can't solve that you're kind of stuck with. Maybe it's a TAM slide, maybe it's the go to market. But if that's the case, just type out slides and maybe the name of the slide. Uh, and last but not least, if you're maybe struggling with design, if you need kind of like idea inspirations for how the deck is going to look, if that's you, type it out as well. I see stories and stories. By the way, your question on whether the session is being recorded, yes, it is, and it goes live. I mean, it's being streamed live on our Startup Club YouTube channel, and that's where it's gonna continue to live. All right. So a lot of story slides, some financial, some slide problems. So I think I got your requests. I'll stop on those slides enough. Okay. So whenever you're struggling, I like this concept of like zooming out. Like if you're struggling with a deck, take a moment to zoom out and sort of understand if your deck is fulfilling its purpose, which should be as telling your company story, which is a summary of what your company has accomplished so far and a vision for what your company can become. Whenever you're struggling and you're stuck with a very specific slide or wording or something like that, just take a moment, take a step back, and check if you're answering this question. Okay, so this to me is the perfect story arc, and I'm gonna move out of the way so you guys can see it and screenshot it. Like if you want to steal a slide from me today, this is the one. So take your screenshots. To me, this is the perfect story arc. We've done a couple of videos about this. I see that the video is like lagging a little bit, so let me see if I can fix that. Hold on. I'll see if I can fix the laggy video. Sorry about that. Try again. There you go. Hopefully that you can still see my screen, and that is a little better, hopefully. Okay. Anyway, so pitch deck story arc. This is to me like the perfect structure of slides. And I'm going to go through each one of these sections, but whenever you're kind of struggling, whenever you don't understand where you're going to put a slide, if it goes in one section or the other, this is where you should go back to and just try to make sure that the slides kind of fit in their own home, right? So let's go over each one of these sections again. Okay, so normally, the intro is not really a section, but normally you would of course start with a cover and then move out to the executive summary, to the traction teaser, which is just a summary. If you have some really exciting traction to brag about, I like including a traction teaser slide at the very beginning of the deck because it sort of makes you more credible right off the bat, right? Right off the bat, you say, hey, like we're growing 20% month over month and we have all this revenue. Doesn't matter what you're doing. I'm already excited about what you're about to tell me. So if you have some really fantastic metrics, go ahead and include that. If you don't, then don't. Then just wait. We'll have time to talk about traction. But it's a little teaser I'd like to include. Very optional. That's why it's gray. But please don't do like bad teasers like beta users or stuff like that, because that's usually not very braggable. Executive summaries, I hate. Please don't include them. An executive summary tries to kind of summarize compress all the slides into one slide, but that usually doesn't work. It creates a complicated mess. So just skip that. Don't worry about it. And then we come to the first section. So again, think of this concept of zooming out. Check out if your section is sort of answering the question that it's supposed to be answering, which in this case is, what opportunity have you discovered in the market? What have you found? What business? What problem? What's happening in the world that's not working well, where there's a business opportunity that you've discovered? Normally, the slides that you would include here are your market overview slide, which is, if you need to kind of get people on the same page about what your market is, that's a fair slide to include. And then a problem or a business opportunity slide. Most of the time, it's going to be a problem slide. Hey, like here's this thing that doesn't work with the world. Always acknowledge the existing solutions. I had a chat with a founder this morning. They were doing like a ghost kitchen kind of situation, and when they at their problem slide just was something along the lines of, hey, like early stage, like recently launched restaurants really struggle to get customers. Like, okay, fine, that's true, but that's not acknowledging the fact that we have solutions for this already, right? We have, online ordering solutions that exist. So I think on a problem slide, on a good problem slide, you always acknowledge what's happening currently with the world, but don't, and if that includes your competition, then acknowledge that rather than just pretending that it doesn't exist. With business opportunity slides, not all pitch decks solve a problem. Sometimes you're just kind of leveraging a business opportunity, a growing market. I don't think cannabis is solving any problem. And I mean, not so much anymore, but in the past 4 or 5 years, we saw a lot of decks of cannabis companies. They're not solving a problem. They're just solving this business opportunity that cannabis in the U.S. is now legal, and a bunch of states that didn't have any stores now that they created a business opportunity. So that's a possibility as well. It's not a problem. Okay, moving on to solution section or the product section, which should answer the question of what have you built to tackle this problem, how does it work, and who is it for? This is normally the section that people find the easiest. Slides to include here are your solution slide, your product slide. It's almost an answer to the status quo section, right? So you have a solution. So you have a problem that you have identified. Here's what we've built to tackle it, right? So solution, product, demo, which I don't love. That's why it's great. It's an optional slide. How does it work? I think is important. Tech infrastructure, if there's something exciting about the company's technology to talk about. Target audience, I think, is a crucial slide. I think that you want to show that you understand who your customers are. That you want to show that you understand that it's not everyone. It's not every early adopter. It's people with this purchasing power that live in this area that are looking to replace this product, that use this, that where their current solution is this one, or are struggling because of this. Like, nailing that target audience to me is one of the most crucial parts of the deck, and one that often gets overlooked. That's not to say your product may eventually go to more people, right? But even I'll use that kind of like food ordering or like food delivery example. A lot of I've seen a lot of companies out of California recently, for example, that are trying to target just people who are working from home, who are looking to eat healthy, like to eat home cooked meals rather than kind of fast food that you would normally get in Uber Eats. That's a niche in itself, right? And it shows that you understand that there's a problem specific to those people. And that's not to say that, somebody that somebody might not order something else, or that you might not go to other types of customers eventually, but starting with a niche that you really understand and just doubling down on your marketing or your sales around that niche is super useful, and investors want to see some of that on your pitch deck. Case study is an optional slide, but I like to include it, especially in B2B products, because a case study is like a nice little tale, right? It's like a little short story to say, hey, here's what we did with this company. Here's how we worked together. Here's how this is working so far. And it doesn't have to, it in a single slide, in a single story, you can talk a little bit about who your audience was, because that's the company that you're using as an example. And you're talking a little bit about who, how your product works. You're talking a bit about how, what comes out on the other end. You're bragging a little bit the fact that you were able to find this customer, and then you were able to kind of tell a successful story with them. So I really love case studies, but they mostly apply for B2B companies. Business model slide, red flag there, because a lot of people struggle with this slide a little bit. A business model slide should be really simple, actually, which is just how you make money. Some companies will go and try and do some financial projections and say, oh, we need 1,000 customers before we become profitable, or something along those lines. But generally, it's just a summary of how you make money, the business model. And then last but not least in this section is the roadmap, which is, well, the roadmap, a great bridge to the next section, which is the market section. Just a summary of your milestones and what's going to happen over the next few months. Normally, it's what's going to happen over the next 1 or 2 years, rather than the next 5 years, because that's not what this round of funding will fund, right? So yes, you want to talk a little bit about like long-term vision, but for the most part, it's, hey, like the capital that you're going to give me, investor, is going to go to these things, launching or reaching this product milestones roadmap. Okay, next section. Next section is market. So the market section should answer one simple question, which is, how much are you going to grow, and how much are you going to continue to grow after this, right? So that's where the market comes in. That's where the go-to-market comes in, and where the TAM comes in. Some of the slides there, traction. Again, if you haven't talked about traction before, or even if you did a traction teaser before, this is a good opportunity to revisit the traction, talk about it again. We have unit economics. When you have traction, when you have revenue, talking how revenue is working, how you're converting customers, and how that's working. Unit economics as to like how much is a customer costing to you? How much are they staying on average? That's unit economics, and it's a crucial slide the moment that you have traction, or revenue, I mean. Go-to-market slide, we talked a little bit about that, and TAM, we talked a little bit about that. Potential outcome slide, there's a really good one really good pitch deck reference is the Uber pitch deck. We're actually making a video dedicated to that, to the Startup Club channel, on kind of like tearing down these popular deck examples. Uber has a fantastic potential outcome slide, which has this funny story that their best case scenario was that Uber would become like a $1 billion company. That's what they expected as the best possible scenario. And they ended up being a much bigger company than that. But I like a potential outcome slide because it sort of forces you to think like, what could go wrong? What if we don't reach our goals? And at the same time, making sure that your expected scenario is still a company that's large enough. We're going to talk a little bit about that as we go through financials. Last main section is the why us section, which should answer the question of why are you and your team the team that's going to change the status quo, that's going to succeed with their solution and their go-to-market strategy, right? So we have, what's that? We have status quo. We presented this problem. Now here's the solution that we're developing. Here's this market and how big it is and how much money we could make from it. And here's why we are the company to do it, right? So I think it follows a really nice story arc. The order of these slides is not written in stone. Break the rules, that's fine. But I feel that this is a cohesive structure for a pitch deck, and that's why I give it to you guys. So slides here in the why section: competitors, competitive advantages, which should focus more around why you're better, or what, not so much about why you're better from a feature list perspective, but more on what do you understand about these customers that others don't, right? That your competitors don't. Secret sauce, if it's something that you haven't talked about, and the team slide. Which, by the way, it doesn't have to be only the founders. It should be the team, or like the core team that's proving that you can achieve all of these things that you've been talking about. Last but not least, financial forecasts. We're going to talk a little bit about those in a sec. That's kind of the next section of my slides. And then finally, they ask how much money you're raising and so on. So a couple of tips on how to navigate this. We have a couple of resources that you could use. One, we built a template that sort of follows this exact structure. It's this one, the starter pitch deck template by Slidebean. You can Google it. And then this other template, the Airbnb pitch deck, is one of my favorite pitch decks of all time. One that I really like to reference a lot. So we have that as a template as well, and it follows a pretty similar structure, though it's a little bit built more like for like a demo day type of presentation. But those templates are available in Slidebean. If you want to sign up, it's free. You can use those. And we've recently built a new AI builder that might be useful. It sort of takes a website, a landing page, and sort of reverses engineer a deck from that. But it's a good start. It follows the structure as well. So if you feel lazy and you want to head start on the slides, you can use that. It's not going to give you a final deck. I can't promise that, but it's a good start. A couple of more ways we can help. We have a subscription called Slidebean Accelerate, where our team actually works with you on finishing developing this deck. So the idea is that you're working on the slides on your end, and from our end, we're sort of assisting, providing help, feedback. And normally that works with monthly pitch deck review sessions. These are live, these are one-on-one, and you literally can book a call with our team to get your pitch deck reviewed. And by the way, that's part of that Accelerate plan on $99 a month. We have a department where our team takes over everything, kind of like a white glove process where we write the entire deck. So you can email us at webinars@slidebean.com if you want some help with that. Okay, let's talk about section 2 from my slides today, which is the investor type. So one of the biggest problems I see is companies going after the wrong type of investor because they don't really understand what stage they're in. So the suggestion I have here is that we built this little chart. We call it the company stage cheat sheet, where we've broken down all of the different startup stages and what milestones you should have accomplished to consider yourself a company in that stage. Now, this might be small to read. I know. We're gonna paste the link in the chat and in the YouTube chat, so you guys can go to the actual page. But here's my attempt at zooming in so I can walk stages. So I'm going to start with pre-seed, and because the one in the middle, and it'll make sense. So what's a pre-seed? Well, a company is a company that has a formed team, so that the team that's going to build this product, the team that's going to scale it, exists. We know who they are. They maybe they haven't quit their day jobs, but we've identified them. We have if it's a tech product, we have a tech engineer. If it's a medical product, we have a medical engineer or a PhD or a chief science officer. But we have the core team needed to build this product. If you don't have the core team needed, that's usually a red flag, and that makes you not a pre-seed company, but an idea stage company. If you're building an app, but you don't have anybody that builds the app, not for you, but with you, if the team can't build this app because they're looking for that engineer and they're raising money for that engineer, then you're not a pre-seed company. You're an idea stage company, and the funding that you can access is very, very different from the pre-seed funding that you can access. So again, pre-seed companies are formed teams. They have a vision. They understand how the product is going to work. They maybe started developing this product already. They've talked to some customers. They understand the need. They've confirmed. They've done all this homework, right? And they're raising money mostly to go on and build this product, right? To maybe spend a few months with their in a hacker house or something like that. I don't know if you do hacker houses anymore. I used to do. We developed a good part of the product in like a 6-month hacker house situation. But anyway, kind of like you're raising money to hire not the talent, but maybe a couple extra hands, and actually deliver on this product and be able to dedicate 100% of your time to building this product. Some companies will skip the pre-seed round, and that's okay. But what's really important is that when you raise a pre-seed round, the money that you raise needs to be enough to get you to the next fundable milestone, which in this case is seed. And a seed round is not a product that has launched recently. It's a product that has launched and has traction and has growth. For a SaaS product, your traction needed for a seed round may be 20, 25, maybe $40,000 in monthly recurring revenue. So it's not only about launching the product, it's actually getting it to $40,000 in MRR, which is not easy, right? It takes a while. So the crucial part of this is that when you raise money for pre-seed, you need to make sure that the money that you raise is enough to get there. Because if you get stuck in the middle and say maybe you launch a product, but you don't have enough traction for it, then you're going to be in this chicken and egg catch-22 situation where you're too late for a pre-seed round, but you're too early for a seed round. And investors hate investing in companies that have a product that launched but has no revenue, because what that story is saying is, oh, you launched a product, it's not working, and who wants to put money in a sinking ship, right? So that's why you always should budget to make sure that you get to the next fundable milestone. Now, the amount of money that you raise comes with questions, and we're going to talk a little bit about those. So one of those questions is, well, is your company ready to raise capital from venture capital investors, from the startup TechCrunch type of investor? And I'm going to paint an early scenario. So let's say that you're trying to raise $500,000, right? You've run some math, you've run some budgets, and you need $500,000 to get this product off the ground. Remember, this may be a pre-seed round, so this funding needs to be enough to get you to seed. Otherwise, it's not going to work out, or you will get stuck in the middle. So let's say they're raising $500,000, and because you've read this somewhere and you've seen other startup valuations, you're thinking that you're going to give these investors something like 15% of the company, which wouldn't be crazy. It wouldn't be crazy. But if we actually run some math on that, well, if 15% of the company is $3.3 million, then you're essentially, if 15% of the company is $500,000, you're essentially valuing the entire business at something like $3.3 million. And that begs a question, which is, well, is your company worth $3.3 million? If you are a traditional business, I don't know, consulting agency, like a services platform, even an e-commerce, normally your valuation would be a multiplier of your sales. This is how much you're selling. This is how much, how much your company is worth. Like a brick and mortar store is usually worth 1 or 2 times their sales. So that's good, but how do you get $3.3 million from just this idea, right? Okay, it's obviously based on the potential here, but the potential for a tech company is really fast growth with really high profit margins. So for your business to be worth $3.3 million today, investors expect that value is going to 10x in about 5 years. The game of venture capital is making these risky bets in companies at very high valuations, granted, but the idea is that these bets will pay off because your company is going to scale so quickly. So how can you justify your business being worth $33 million in 5 years? Well, one option is that you may have a large EBITDA margin. Normally, companies can get valued at something like 5 times their EBITDA. So if you're building something like software that's a high margin product, a high margin solution, there's a good chance you might scale to $6 million in EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. Basically your net income. But if you can get to $6 million EBITDA, you can justify your company being worth $33 million in 5 years, right? So another option is that somebody's going to acquire you for something like $33-35 million. That's a way to justify it. Maybe somebody's buying your customers, right? So when Meta or Facebook acquired Instagram, they paid about $3 per active user on Instagram. So if maybe you're a pure play, so like no revenue platform, but you're still going to grow very, very fast, then that would be a way to justify your valuation of 33 million. Can you get more investors interested, right? Can you raise a Series A, Series B at that valuation eventually because your company still has room to grow, or are you going to go public? So the reason I give you these questions is you have to ask yourself these questions as you sort of come up with a valuation number. Why? Well, because a lot of companies that are kind of on a path to making $5 million in revenue or $7 million in revenue in a few years, they just can't raise venture capital. It's not the type of capital that they need. They might need some other kind of executive co-founder situation. They could go to banks or ask for a loan for that business, but it's normally, yeah. But unless your company is going up on that really massive scale, venture capital, this type of venture capital, isn't necessarily for you. Okay, so let's talk about the next red flag in pitch decks, which is a bit about budgeting. So, trivia question for you guys, and let's see if you've been paying attention. You guys on YouTube, you've been shy, but I see some people following the live as well. Okay, here's a trivia question for you guys. How much should you be raising for a seed round? Is it A, 18 months of runway? Is it B, whatever it takes to reach the next funding round? Or is it C, enough to launch the product? Let's see what you guys get. It's a trick one, and there's a banana peel in that question. So let's see if you guys fall for it. I see Jennifer on a next round. That's a B. Vanessa on a B. Nathan on a C. So let's talk about C first. Well, C is the easiest one to write out because if you're a seed company, then you should have already launched a product, right? Remember that when you raise money to build a product, to launch a product, that would be in a pre-seed round, and then you would raise that money to get to the next fundable milestone. So that C is incorrect. Now, we did say that when you raise money, you should raise money that allows you to get to the next fundable milestone, which is B, and B is the right answer. But A is a bit tricky, and the reason I put A there is because this happened to us when we raised our seed round. Nobody had told me that seed money had to be enough to get to Series A. Nobody told me this. Nobody told me that the money had to last through Series A. So we raised the seed round. We just reinvested that money, more or less measuring for 18 months of runway, A, right? And then 14 months in, we're 4 months before running out of money. We have revenue, and revenue is growing. We had about $1 million in subscriptions, $1 million in annual run rate. I started kind of emailing investors again saying, hey, like we're ready for our Series A. We're about to run out of seed capital, blah, blah, blah. We have $1 million in ARR. And most investors, if not all of them, said, hey, that's really cool. Congrats. But you guys are not in our scope yet because we invest in Series A companies, and to us, a Series A company is usually a company with $1.5 million, $2 million in subscriptions, not one. You're still early for us. And well, lo and behold, nobody told me that. I'm 4 months from running out of money. We don't have the money to get to that stage, right? To get to the next fundable milestone. So we were in real deep shit. We had to let go a lot of people, cut our expenses, and we managed to survive. But the problem was we had budgeted for 18 months of runway, because that's what somebody told us. So that's only half the answer. your round should last at least 18 months because it normally takes 18 months to go from one milestone to the other. But you shouldn't just raise money on the amount of time. You need to raise money on reaching those goals and grabbing the next funding branch, if you will. Okay. So again, because when you're doing pre-seed, you're going from pre-seed to seed, and that means that there are going to be orders, there are going to be revenue. There is going to be revenue. You're developing the product for a few months, you launch it, and that pre-seed money will still fund some of your product launch. So you have to run some budgeting, right, on how quickly you're going to grow, right? You have to get to that milestone to $25,000 to $30,000 in MRR if you're a SaaS business to raise a seed round. So you have to budget how long that's going to take after you launch. And then a lot of founders will, when they're trying to do that, they'll come with something like this, where they say, hey, okay, we're gonna generate 700 orders as we launch, and then that's just gonna grow 10%. And I've seen this in formal professional financial models where they're just taking the number of orders from the previous month or the revenue from the previous month and just scaling that 10%, and that's it. So if you just actually plotted that on a chart, it would look you generate a chart that looks like this, which is pretty. It looks like a really hockey sticky and really exciting for growth. But this is just, I mean, it's bullshit, right? Because we don't really know what's going to drive that 10% growth. So what we want to understand is, and we can't really use that for forecasts. If you just assume that you're going to grow 10% and you raise money based on that, what if you don't? Then you're going to run out of money sooner than you expected because you didn't run some good enough projections. So what do? I'll give you the answer. Okay, so we've established that whenever we raise money, we're kind of swimming towards that milestone, right? We're trying to get to that round milestone, that revenue milestone. And then the question is, well, how much revenue do we have and how many expenses do we have? But the real question is, well, what's driving that revenue? What are we doing that's going to scale that revenue up, and what are we doing that's going to scale those expenses? What's the driver of your revenue? What are the drivers of your costs? So let's, just to clarify, when I say orders, right, 700 orders scaling by 10%, don't do that. But orders could mean traffic, could mean subscriptions, could mean customers, monthly active users, customers in a marketplace. And at the same time, well, what do these orders drive, right? If you're in e-commerce, those orders are going to be fulfillment costs. If you're a SaaS, those orders are going to be hosting costs. The more orders you have, the more your SaaS expenses are going to be your hosting expenses. So we started to kind of land at something that looks like a causality, where yes, we have revenue at the core, but the more revenue we have, the more costs we have, right? So revenue is a driver of costs normally. The more, again, if you're an e-commerce t-shirt shop, the more revenue you have, the more t-shirts you need to produce, the more t-shirts you need to print, the more shipping costs you need to cover for shipping all this product, right? So revenue and costs. So revenue drives costs, and costs are normally very proportionally tied to your revenue. But the question here, the real question that I want you guys to if you take two lessons from today, it's one, the slide on the pitch deck structure, and two, this, which is, what are the drivers of your revenue? Revenue doesn't just grow 10% month over month magically. There's something driving it. There's something that you do that makes you generate more revenue. And that's the way you have to budget and forecast. So one example of a revenue driver could be your marketing campaigns, right? So your search ads, your display ads, retargeting. Another driver of your revenue could be your sales, right? So maybe you're a B2B platform, enterprise, you're doing business development, you're doing cold emails. That's what's driving your revenue. But another driver could be something broader, something like more end user based, more mass market, like organic traffic, right? So the more organic traffic you have, the more revenue you generate. Maybe it's based on ads or just conversions and signups on your website. And you could also have returning customers, right? So the more customers you get through the door, there's a fair chance that they're going to come back and make another purchase. So you want to measure that repeat rate and understand how it works. And again, all of these drive revenue, but they're not all created equal. Some of these are expenses, right? So paid marketing campaigns, you have to spend money. The more marketing campaigns you run, the more money you have to spend. So you have to budget for that. Same with outbound sales, right? So if you have an outbound sales team and you want to grow faster, I mean, you could assume that your sales team gets a little better. Maybe they convert more people per month, but there's a limit to that. You can't assume that a salesperson will outbound convert 100 customers. That's pretty unlikely. So chances are there's a limit to efficiency of how many conversions can a single team member drive. And beyond that, all you have is just, well, hire more people like them, right? So like grow that team so that you grow your revenue. But growing that team has a cost, right? And that's kind of like what I'm trying to portray here, that these blue boxes, blue pills, refer to the fact that, hey, I need to spend money to make money with these channels. That's not to say you don't spend money to make money through organic traffic, right? SEO costs time and effort, money. But it's not directly proportional, right? You wouldn't say that if you double your SEO team, you're going to double your SEO traffic. That's not how it works, right? So it's probably more like a fixed cost. But the point is, again, these are KPIs or expenses that you want to track because they all drive revenue. And these arrows, like how much do we have to pay in paid marketing to drive $1,000 worth of revenue? That's your cost of acquisition, right? And that's what those arrows mean. So here's an example. I'm going to kind of navigate quickly through this. This is what we call internally a financial model map. And I haven't used the word financial model so far because it sounds like a mouthful, and a lot of people get freaked out when they hear financial model because it sounds like, but it's actually not that hard. And the essence of it is something like this, right? The essence of budgeting is something like this. It's not just saying 10% month-over-month growth. It's saying, okay, in order to get new customers, we're going to have to spend money in these two drivers. So these are channels, right? Organic traffic and paid traffic. And the more we spend in paid traffic through this cost of acquisition, we're going to convert that to orders from new customers, right? Which drive up to the total number of orders, which eventually drive revenue. And for every order, we have to pay fulfillment costs. And for every revenue, you have to cover the cost of the products themselves. But at the same time, we also have this path down here where we have orders from new customers and some of these customers become regulars, right? They'll come in and make the orders, and we can track that. And taking this, like mapping this into this visual board, this flow chart situation is, I think, rather simple. It's also a really good exercise to sort of understand how your business works, what drives it, how it connects, and and the most important part is once you have something like this, connecting this on a spreadsheet is actually pretty simple. And the end result could be something as complex as this, right? Where you have a good spreadsheet with templates and KPI tracking and monthly dashboards and stuff like that, which we have for free. So we have a bunch of templates now for financial models. You can download those. But again, this template, again, it's available on our website. Just Google financial model template. I guess we can add Slidebean to that. We'll paste the link. This template has all of this stuff. We've noticed that we've color coded revenue and cost and SG&A. Template is free. It also has these dashboards on use of funds and revenue scaling and so on. But you can't really take advantage of this stuff unless you were able to sort of distill how your business works into those financial model maps I showed you. So a couple of ways we can help further on it. I don't have more time to talk about financials, but we have a bootcamp that we run every month, which is kind of like an intensive 1 week version of the last 15 minutes. So it's just a $99 flat cost for the whole bootcamp. It includes some pre-recorded sessions, it includes some live sessions, and you will have perpetual access to all of the materials, including a bunch of templates that we've pre-built for it. Or if you need our actual help from our team, kind of getting involved and helping you build or understand these financial forecasts, we have service for that as well. So we're happy to help. Okay, so I think I have like 5 slides left. So if you want, if any of you guys have questions, both in the YouTube stream or in the webinar stream, now's the time to start typing those out. I have Q&A open if you want to leave them there. It's probably better than the webinar chat, but yeah, drop them in the chat as well. Yeah, so the last point I'll make before I wrap up my slides is do not send cold emails under any circumstance. Cold emails don't work for fundraising. You can build a perfect deck, and if you send it to people via cold email, they're not going to read it because investors don't like cold emails. They don't read cold emails. That's not how it works. Finding investors really, I feel sometimes like a broken record saying this, but this is the way it really works. Fundraising works through intros. It's a networking thing. It's at least having somebody that can vouch for you, that can give you an intro to other people. And I know that finding investors in your network is hard. I'm Costa Rican. I didn't have a network when I started my first company. And I sort of built one from scratch. So you can build one from scratch. It takes time. But what I was really surprised is that a lot of the investors that eventually came into the company, I kind of knew, or at least indirectly, like there was somebody that could have introduced me to them. So leveraging those intros is really useful. We have this tool in Slidebean called the Investor Finder. What we do is we scrape the web for people who have a tag of investor or who work for a venture capital firm or that that claim that they invest in startups. We ran a whole crawl. We kind of classified them by category, by stage, and so on. And for the longest time, we gave our customers their email addresses, and then they would just take those and email blast everyone, which of course didn't work, and then we get complaints. So the way this actually works is by you navigating your network to find them. So instead of giving you emails, we now give you their LinkedIn profiles. And essentially what you're supposed to do is go to LinkedIn, see if there's a second level degree connection that you can use to kind of bring and bridge that connection and ask for an intro. And this is, I'll let you screenshot this as well, how to ask for a more intro. You can kind of steal this format here, where kind of be nice to your business contacts first, talk about the context of the intro and provide a blurb that the other person can forward. People don't want us, you don't want the person who's doing you the favor of an introduction to have to re-explain what you do. Maybe they don't understand it well. Maybe they're going to pitch it the wrong way. So if you just send the blurb of what you do, that's a really good, that's a better alternative than just letting the person who's doing the intro do the work. And then with that, last slide. What I really want you guys to understand is that, from that warm intro, you ask for permission to send a pitch deck, and then you go to a first meeting. But from that to getting your money, there's still a lot of work in the middle, right? You're doing term sheets, you're doing diligence. Elizabeth Ian, one of our investors, has this blog post where she says that you have to reach out to 100 investors for every $500,000 that you want to raise. And in my case, that's kind of true. Like my little spreadsheet thing with investors when we were raising our seed had 142 people on, like, it was like, I didn't want to pay for a CRM, so I just used like a spreadsheet. And I would keep tracks of every conversation. Many of them were email intros that never turned into anything, but I did try to reach to over 100 people so that we managed to raise something like 800K, which is what we raised for seed. But it is a task. It is a full-time job for the founder. It's not going to happen in weeks. It takes months. So, be sure to prepare yourself for that. We have this little video on how the road goes from pitch deck to funding if you want to watch a little longer on how that process works. Okay, so before I jump into questions, I see a question from Jennifer. Just last commercial on resources. If you need our help with any of this stuff, our accelerated plan is probably the best deal. You get monthly one-on-one sessions with our team to review your pitch deck or review your financials. You get access to the bootcamp that I was talking about. That's also included in the plan, and it's just $99 a month. Or if you'd like our team to actually work on your pitch deck to build it for you, more like a turnkey white glove service, just email us at webinars@slidebean.com. Those are all my slides. So now I can jump into your questions. If you want to drop them, make sure that you don't forget before we run out of time. Okay, Jennifer, so do you mind expanding on the financial services available for a pre-seed company building a feasibility study? Yeah, I mean, a feasibility study is one thing. It's not necessary. I mean, it may overlap a little bit with what a financial model is, but normally the way that works for us is our team takes over the model. We build a model map for you, make sure that we understand the business, that we are in the same page about how it works and how you make money. And then we build a custom spreadsheet for you guys and teach you guys how to use it. So it works as a subscription because normally companies need to stick around for a few months to make sure they understand the sheet, make sure that they know how to use it, and to run some forecasts, which are also always changing. But our team takes care of keeping the model up to date with your actuals. So as you actually have expenses, real expenses, or revenue, we'll always keep the model up to date. That's kind of what it covers. Victor, we do have a recording of the session. You can just Google the Startup Club channel. That's where we have all these sessions recorded and published. Vanessa, I'm in the idea stage. Where can I find an app developer? That's a great question. I always like to stop when this question comes up. It doesn't always, but when it does, I always like to stop for a sec to think. A lot of executive co-founders, I'll call them, or like business co-founders, people with a business background, they normally think of the person who's going to build this app as their subordinates slash, I mean, employees, subordinates. Um, why? Because they think they're like, well, I have this idea and it's a great idea and it's a great product. I just need somebody to build it. But building is much harder than that. Normally, also, like, no offense to you particularly, Vanessa, who I've never met, but um a lot of executive founders don't have are not great at product. They're not great at designing the product or at understanding what features come in or shouldn't come in, or how the back end should work. And those are all very important, very crucial questions to build a product. So I see this case a lot where an MBA type of persona will go and say, "Oh, I just need an app developer to build this." But what they really need is somebody who understands the technology that they're looking to build, right? So it's not just, hey, just build what I say. It's like you're actually looking for a co-founder, uh, for somebody that is as crucial to this company as you are, right? So the person that comes up with the idea should not by default be the CEO, or the CTO. They should just, build the best possible team around them. And I think that oftentimes, non-tech people try to think of tech people as, oh, I just need a developer to build it. And first of all, engineers will hate that. They hate to be treated like that. Um, and more importantly, you're gonna find it very hard to recruit people if you're just saying, oh, I just need to hire someone to build this for me. Uh, what what works best, I've found, is, hey, I need somebody to build this with me, right? And changing that mindset to think of them as your co-founder rather than just an employee. Nathan, so do you recommend any different decks for traditional bank investors versus private investors? I think the structure is pretty much the same. I think traditional bank investors are going to expect more text. Honestly, it's not necessarily more substance, but definitely more text. Um, but yeah, that. Overall, I think you can follow a very similar structure from one to the other. Okay, I see Mark. Mark, what is the best time to look for investors when you've been bootstrapping? And what are your thoughts on investor payback priorities and multipliers? Um, yeah, so best time to raise money is at the stages I mentioned, right? So pre-seed, that's pre-launch, pre-product. Help me finish this product and launch it, right? And then you're not going to be in a good position to raise money ever. You're not going to be in a good position to raise money until you get to seed stage, which is what? 20, 30K in MRR, growing revenue, prove that your product works, that customers love it. That's another great time to raise money. And then kind of skipping ahead to Series A, same, right? $2 million in an annual run rate, or the equivalent in, for other business models that are not SaaS. Again, growing, fantastic understanding of your growth. The little cheat sheet that we shared, can give, but those are the right milestones, right? That's the moment to raise money. If you've been bootstrapping to launch the product, don't go after investors right after you launch it, because that's just a bad position to be in. This sounds counterproductive, and I hate that I'm going to be on record saying this, but I guess it's true. If I had a product that was ready to launch, I would not pitch this product as ready to launch. Why? Because if you go to an investor and say, hey, I have this product, it's ready to launch, I need to raise money, they have all the time in the world. And they're like, oh, I can just wait until you launch it and I'll see if it works or it doesn't. Like, I don't have to take that risk. Right. So I think that launching a product just right before trying to raise money right before you launch or immediately after you launch is a really, really shitty time, because everything that they're going to care about is metrics. And if you've been bootstrapping, you're not going to have a lot of money to get decent metrics. That's the problem. I would rather, I recommend this to companies a lot. If you have enough money to bootstrap to launch, but nothing more, then you don't have enough money to bootstrap, because you need to get to seed stage. And if you can't get to seed stage, then you should raise money now, so that you have enough money to get there. Hope that made sense. Okay, moving from consulting via MVP to building a platform. I don't know if that's a question mark, but I'm assuming it relates to the same thing. I have another question from Titan. I am partaking in this wonderful webinar from Ghana. Hey, what's up? My take is on 3 points. How do I get an investor to convince them to invest in my product startup? I guess that's a little bit of the last hour. I think it's a combination of everything we've talked about. What's the best way to market an emergent market like African countries where most people are not aligned with marketing techniques? I wouldn't go to investors in outside of your geo, honestly. Investors don't generally like to invest in markets that they don't fully understand. So I would say that it's going to be really unlikely for you to raise money from American investors for a product that you're going to launch in Africa. You're probably going to, at least for the foreseeable future, find investors that understand the space where you operate in. And then three, do you really need a co-founder? I mean, aside from the reasons I told you, where you need the skills to to solve the product to get the product to the first version. I really think that co-founders are valuable for other reasons. Like two, I'll note two. One, sanity check. Like if there's nobody in if everybody in the company is an employee and nobody else, and you don't have any other authority that can tell you, hey, like this product feature that you're asking is stupid. Don't do it. We shouldn't build this. Like somebody in your company should have the authority to do that. And if everybody's your employee, then they can't, right? That's not the relationship that normally exists with employees. So, honestly, as a sanity check, my co-founders have often stopped me from doing really idiotic stuff. But I respect their opinions enough for them. If both of them agreed and say, hey, like, I don't think this is a great idea, it's like, okay, maybe it wasn't. But you need somebody who you respect that much and who, also respects you enough to tell you and that, that feels comfortable doing so. One. And two, if you can't find a co-founder, that's usually a red flag. That means that you're building something, but nobody really believes that you can build it, or nobody's really excited about this product, or you weren't able to find somebody that was excited about this product, business opportunity. And that's usually a red flag, right? Like there should be at least, I mean, if this is really exciting, there should be at least two people who believe in it, right? And if you're not able to find a second person, that tends to be a red flag for investors. Y Combinator, for example, won't take solo founders at all. Like they only take teams, and that's that speaks a little bit to that. Jennifer, what are your thoughts on bonds for fundraising during seed? How many is too many investors? I don't very not traditional to use bonds for fundraising, at least not for tech startups. That doesn't usually happen. How many is too many investors? I'd say that I'd rephrase that answer as, you shouldn't do tickets like investment checks under 10K. That's like a small check. 10K is, I'd say, a real ideally like 25K. That means that you could have 20 investors on a 250K round, which is a little annoying. It's a lot of people, but it's not too crazy. Yeah. All right. I have Jennifer. I've had a few issues finding tech co-founders locally, even when I discuss equity split and cap tables. Considering resorting to a university tech transfer, could this hurt our company outsourcing the patent in our goal to reach Series A, even if it's a university? Um, I don't think the university can patch the CTO situation. So I've lost two CTOs to them taking the idea and trying to develop it on their own. That's actually a good example, Jennifer. Glad you brought it up because if they don't need you, if they see they see this and like ideally like a team of founders should be, hey, like I have this idea and I'm bringing this idea to the company, but I'm also bringing this experience, this skill, this value to the business. And then you're bringing your skill, your value of building this product. But yeah, I mean, I hate to use that example, that's such a cliche example, but if you look at, the Facebook story and the Winklevosses getting screwed out of Facebook, it's kind of what happened, right? Like, it's like, what are they bringing? Nothing. They just brought the idea. So this engineer guy can just build it on his own, and why would he share it with the other guys? And that's real, right? It's shitty what Mark Zuckerberg did, but point being is like he didn't need them as much as they needed him, and that's starting with their left foot, right? Like there should always be a balance where founders need each other. Like I'm not a tech co-founder for companies, but I like to think that the next time I start one, people see the value in my marketing skills or in my fundraising skills or in my experience running a company. Like that's what I bring. And I don't bring everything. I need a teammate to work with me on this. But like it becomes like a symbiotic relationship. But if they're feeling that you haven't made it clear maybe that the value you're bringing in your experience to fundraise or your experience to market this product, and that's why they're feeling that, hey, why don't I just build this myself? I mean, it's a shady thing to do, but same thing applies even if you didn't meet them, right? If you launch a product, or if you're building a product and somebody else sees your idea and takes it, it's not, somebody might look at I don't know, Lyft, right? Like it's just the same thing, right? So the question is not who came up with the idea first, is who executes it better, and that again connects to your skills and what you bring to the table. Okay, do you think funding with friends is a bad idea? I don't think so. No, I think it is a good idea. We call early stages of funding are often called friends and family. Just make sure that the people who are investing in you understand what they're getting into, right? Like don't overpromise, state the risks, and like understand equity, and understand that it's the money. There's a good chance they won't get anything out of it. That's the likely scenario. Like just judging by startup success rate, chances are you will lose your money. And you should be very forward about this, right? Like there's a great opportunity, you're going to give it everything you have, but they shouldn't hold it against you if it fails. And I think that's when I raised money the first time, I was poor. I'm not saying I'm rich now. I'm just saying I was just very poor. So I could never have invested in companies. But if I want to believe that soon enough I'll be able to write small checks to friends that are building cool stuff that I believe in. But again, I understand the market and the way startups work well enough to say, well, yeah, I'm going to write this check to you, but do your best, and then I mean, if things go south, then I mean, that's fine. I mean, I took that risk, but sometimes especially with family, there is resentment, especially if they're inexperienced with the way startups work, etc. So just be careful with that. And then last question, I think, because I have to run. Anonymous, is there a deadline after launch of who I call a co-founder? It's now almost a year ago. No, I mean, we have a good video about that. Funny that you mentioned it. We have Elon Musk, like him or not, he took the Tesla guys who created the company, who appear in the paperwork to found the company, didn't want to give him the co-founder tag, even though he essentially funded the whole company, was like employee number 5, and was a key to its development. And they actually went to court, and he won that lawsuit, and that allowed him and a few others to call themselves co-founders. So I think it's a technicality. I don't think that I personally don't think that founders are just the people who started the company. I think it's just people who are a crucial part of it. But ask yourself why the technicality is coming up. If it's just a pride thing, of just like being able to call yourself co-founder, or if it's an equity thing, then I mean, you could have somebody who has a decent equity stake in the company and came in later. That doesn't matter. And the fact that they call themselves co-founders or not, that's just another. I mean, that's just another question, right? Maybe related, maybe not. But no, I don't think there's a time limit to how much you can call yourself a co-founder. Okay, guys, really appreciate. Thanks everyone for tuning in. I see a bunch of people on the Zoom link, so thanks a lot for joining. Hope that this was useful to you guys. Again, if you want any help with the process, Accelerate is probably the best way to go. All Accelerate subscriptions come with a kickoff call with me. So I literally talk to every single customer that comes in, and it's a good chance to kind of catch up a little bit on strategy, fundraising, or more specific questions if you have any of those for me. So I'm hope to see you guys in the next over the next few weeks as I do my Accelerate kickoff calls. We'll see you in the next one. Oh, by the way, there's another webinar coming in next week where we dive a little deeper on the financial side. We'll paste the link to that, and we'll send that to you over email. But hope to see you there as well.